Dell just delivered one of the most surprising AI earnings reports of the year. This is not just a PC company anymore. In one quarter, Dell reported more than $16 billion in AI server revenue, booked over $24 billion in AI orders, and raised its full-year AI server expectation to $60 billion. And the stock exploded. So the question is simple. Is Dell becoming one of the best ways to invest in the AI infrastructure boom, or did investors just chase the stock after the easy money was already made? Today, we're putting Dell through the earnings filter. No hype, no price target fantasy, just the numbers, the business engine, the bull case, the bear case, and the decision checklist. Welcome back to the channel. This series is built for investors who want to understand what actually happened after major earnings reports, not just reacts to headlines. We are not trying to predict tomorrow's stock price. We are trying to answer a better question. After the latest public financial report, does the business quality, growth story, valuation, and risk profile still make sense? Today's stock is Dell Technologies, ticker symbol DELL. And this one is interesting because Wall Street may be changing the way it values the company. For years, Dell was seen as a mature hardware and PC business. Now, the market is asking whether Dell should be treated as a core AI infrastructure company. Let's start with the shock number. Dell reported record quarterly revenue of $43.8 billion. That alone would be impressive. But the real story is inside the Infrastructure Solutions Group. This segment includes servers, networking, storage, and now the most important part of the story, AI-optimized servers. Dell reported $16.1 billion of AI-optimized server revenue in the quarter. That was up more than 700% year over year. Even more important, Dell booked $24.4 billion of AI orders during the quarter. That means demand did not just show up in revenue, it also showed up in the order book. For investors, that matters because AI infrastructure is not a one-quarter story if backlog and new orders keep expanding. The company also increased its full-year AI server revenue expectation to $60 billion. So the headline is not just Dell beat earnings. The headline is Dell may be turning into one of the largest AI server companies in the public market. And that is why the stock moved so violently. Now let's break down the engine. Dell has two major business buckets. First, the Client Solutions Group. This is the PC business, commercial PCs, consumer PCs, workstations, and related products. This segment still matters. It generated $14.6 billion in revenue in the quarter, up 17% year over year. But the real engine is now the Infrastructure Solutions Group. This segment reported $29 billion in revenue, up 181% year over year. That is a massive acceleration. Inside that, AI-optimized servers became the star of the show. Traditional servers and networking also grew strongly, and storage produced a record first-quarter result. This is important because Dell is not just selling one AI box. It is selling infrastructure, servers, storage, networking, deployment, supply chain execution, enterprise relationships. In simple terms, NVIDIA may sell the chips, but someone has to build, integrate, ship, and support the systems that enterprises and cloud customers actually use. Dell is positioning itself as one of those companies. That is the business engine. The bull case has three parts. First, demand is real. Investors have worried that AI spending might slow down or that only a few hyperscalers are buying aggressively. Dell's quarter pushed back against that fear. The company showed huge AI server revenue, huge AI orders, and a higher full-year AI server outlook. Second, Dell has scale. AI servers are not easy to deliver. There are supply constraints, memory cost pressure, GPU availability issues,
pricing complexity, and customer concentration risk. A smaller company may struggle with all of that. Dell has supplier relationships, manufacturing experience, global logistics, enterprise sales channels, and the balance sheet of a giant. That scale can become a competitive advantage during an AI infrastructure build-out. Third, the market may be re-rating the stock. Historically, Dell was not valued like a high-growth AI company. It was valued more like a mature hardware company. But if investors now believe that AI infrastructure can drive a multi-year growth cycle, then the market may be willing to assign Dell a higher valuation multiple. That is how a stock can jump even after it was already moving up. When the market changes the story, the valuation framework changes too. But this is where we slow down, because a great quarter does not automatically mean a great entry point. There are 4 risks investors need to understand. Risk number 1, AI server margins. AI server revenue can grow very fast, but the key question is how profitable that revenue will be. Hardware businesses can have lower margins than software businesses. If Dell sells a massive amount of AI infrastructure but margins compress because of component costs, pricing pressure, or customer concentration, then earnings growth may not match revenue growth. Risk number 2, cyclicality. AI infrastructure demand looks extremely strong right now, but hardware cycles can be brutal. Customers may overorder, pause spending, digest capacity, or renegotiate pricing. If AI server growth slows faster than expected, the stock could re-rate downward quickly. Risk number 3, valuation after the move. Dell is not being ignored anymore. After a huge stock move, investors are no longer buying the same setup that existed before earnings. The question changes from, is Dell underappreciated, to how much future AI growth is already priced in? That is a very different question. Risk number 4, dependence on the AI capex cycle. Dell's story is now increasingly tied to the broader AI data center build-out. If AI capex continues expanding, Dell benefits. If large customers slow down, if supply tightens, if pricing changes, or if the market starts questioning AI returns on investment, Dell could get hit even if the company executes well. That is why this stock is exciting but not simple. For the next quarter, I would watch 5 numbers. Number 1, AI server orders. Revenue is important, but orders tell us whether demand is still building. Number 2, AI backlog. A growing backlog suggests future revenue visibility. A shrinking backlog could mean demand is being fulfilled faster than it is being replaced. Number 3, ISG operating margin. This is critical. If the Infrastructure Solutions Group keeps growing and margins improve or stay healthy, that supports earnings power. Number 4, full-year guidance. Dell already raised expectations. Now the market will expect execution. Number 5, cash flow and shareholder returns. For a hardware company, cash generation matters because it shows whether growth is translating into real financial strength. So, what is the verdict? Here's how I would frame Dell after this earnings report. Business quality, improving. Dell is no longer just a PC cycle story. The infrastructure business is now the center of the narrative, and AI servers have changed the growth profile. Growth, very strong, but tied to AI capex. The numbers are exceptional, but investors need to remember that hardware growth can be volatile. Profitability, strong, but margin quality needs to be monitored. Revenue growth alone is not enough. The next phase of the story depends on whether Dell can turn AI demand into durable earnings and cash flow. Valuation, more demanding after the stock surge. The opportunity is real, but so is the risk of chasing after a massive move. My personal framework would be this. If you believe AI infrastructure spending will remain strong for multiple years, Dell deserves serious attention. If you're worried that the AI server cycle is overheating, then Dell may be a stock to watch carefully rather than chase aggressively after a huge rally. For long-term investors, the better question is not, will Dell go up tomorrow? The better question is, can Dell turn this AI server boom into repeatable earnings power over the next 3 to 5 years? That's the real test. Dell just proved that the AI infrastructure boom is not only about chip designers, it's also about the companies that can build and deliver full systems at massive scale. That makes Dell one of the most important AI stocks to watch right now. But after a major post-earnings move, discipline matters. The story is stronger, the valuation is higher, and the margin for error is smaller. That's exactly why we use the earnings filter. If you want the next deep dive, subscribe and follow the series. Next time, we'll look for another stock where the headline move may be hiding a much deeper investment story.